It's Michael Burry move, a little silent capital. Shorting the housing market. Going to be asking the question, or at least I'm going to try to put forth the argument that the investment banks have gotten a little carried away again with these mortgage-backed securities. I will throw on the side a little bit of a picture of just some of the stock prices and how they changed 08, 09, 2010 after the mortgage collapse. I'm also going to have this here for you. You can see you have Freddie Mac, Fannie Mae, Ginnie Mae, and private label. What I want you to especially notice is this is from Wikipedia. So one, it's not the greatest graph probably in the world. One thing I want you to know, we're going to look at it, I'll show it to you, but Fannie Mae and Freddie Mac are not backed by the government. So that'd be the gray and the lighter of the two blues. So in this section, we'll say it's what, 60%, maybe 60% again, and about 60% again, maybe 50% on this one. No, 60%, okay? Private label is very small. They basically got rid of the private labels back here. But Ginnie Mae is basically this dark blue, and this still has some connection with the government. Ginnie Mae, typically they are associated with the FHA loans that we'll look at. But I just want to tell you like where we're going. The point I'm trying to make is that there's a large amount of these gray and blue mortgage-backed securities that are not backed by the government. I'll prove that to you in a second, but that's going to be my jumping off point for this video. If you're not familiar with mortgage-backed securities, just bear with me. If you are, you can just check out the stock charts. So basically mortgages here, let's say this is my house, this is your house, this is your best friend's house, this is your cousin's house, okay? Let's say all these mortgages get pooled up into one big bundle by the banks. So someone, sells off our mortgage to a bank, they securitize it. And now say we can come back and we can invest in this pool. Say maybe, I don't know, most of the money comes in, it's a pretty profitable thing. They take their little management fee and say we all get paid 5%. Say we all, invest $100 in here, we make $5 or whatever. Okay, that's great. What they can do further, this would be basically like a pass-through mortgage-backed security and what they call a pass-through. You could do a CDO, like a collateralized debt obligation. So collateral being the mortgages. You can break it up, right? Like this, if you haven't seen it before, basically what it does is instead of having one homogeneous product where everybody has the same 5%, well, now we can get like a risky one that'll give 12%, a kind of middle of the ground, 9%, and a 7% one. So that gives people more options, right? You can decide, well, I'm kind of one of these people. I want to go ahead and sign me up for the 12%, or wherever, different investors would come in. Now it's 3 products and not just one product. It has like a wider availability and more demand. So the way it basically works is, let's say like I get laid off or something, or they stop giving me my unemployment benefits, so I can't pay, and say same thing happens to you, and let's say like, I don't know, somebody else can only pay like 1 out of 3 months. So now this is not fully funded. Basically what happens is any shortfalls or money that doesn't come in, it comes out of the high risk area first. So say like those things happen, I don't pay, you don't pay, and our other friend doesn't pay or something. Maybe 75% of the unsecured money doesn't come in. What needs to come in this little section right here. So what would happen instead of these people getting 12%, they'd only get 75% of that 12%. Or they would only get 25%. There'd only be 25% of that money left, right? Which means they would get a 3% return, not a 12% return. These people, they're good. They still get their full 9, and these people still get their full 7. So these guys kind of got the best. Say things got worse and this person also doesn't pay, then maybe all this unsecured money, all the cash flow going into this is gone. So these people get 0, and say half of this doesn't come in, so these are 4.5%. These people still get their 7. You can imagine if things get really, really bad, no money for these people, no money for these people, and these people get 2% of the 7% they were expected return. Okay, so that's basically the idea. Crash course real quick on mortgage-backed securities. So I'm going to take us over to this Wall Street Journal article. I'm basically going to now try to prove to you that there are a lot of mortgage-backed securities being purchased, and I'm going to give you a sense of just how much that's happening, where we are. I'm going to show you a few graphs. In the end, I'm going to suggest, if you're interested, it's your money, don't listen to me, this isn't financial advice, I should say, but I'm just trying to put forward the idea that if you are a person who thought, I think the banks are really in a bad spot here, and they're going to suffer a lot of losses, I have 3 financial products for you at the end. Their mortgage securities are flooding the market. Thank the Fed. Basically, what I want to tell you from this is right here, the value of single-family mortgage-backed securities issued by Ginnie Mae, Fannie Mae, Freddie Mac totaled almost $322 billion in August. This is August of 2020. Yes, that was a new monthly record. Okay, so there's your first point of, is this thing really taking off? I'm going to say yes. We're going to move over to this article from Reuters, Treasuries on steroids. They say these are the U.S. banks' mortgage bond trading bonanza. So this article should give it to us pretty straight. It's going to see Wall Street banks are on track for a record year of revenue, okay, from trading U.S. government-backed mortgage debt, industry sources told Reuters. So there's another point. Revenue from trading bundles of home loans at the biggest global banks, including JP Morgan, Citi, and Goldman, among others, expected to top $3 billion. These are revenues, okay? These aren't like the value. $3 billion in mortgages is not really that many, right? I mean, not really that many homes. But they're talking about revenues. One source said with the direct knowledge of the bank's trading revenue beating last year's peak of 2.5. So they're pulling in more revenue. Could either be due to more volume or they're doing it a little bit more profitably. Hard to say. But definitely, let's see what we can pull from Daniel Hyman. He's a MBS portfolio manager at Pacific Investment Group, PIMCO. Buying mortgages in March was one of the best trading opportunities in mortgages since the last financial crisis. Okay, so obviously he said that it was a big deal. The surge in demand activity has also allowed new names to enter the space like the Bank of Montreal. Bank of Montreal and JP Morgan did not wish to comment. The trading boom is likely to provide a silver lining in an otherwise tough period for U.S. banks amid lower interest rates, which we know about. And we know that the Fed is committed to those, and rising bad debt. So one, I don't know the numbers behind the rising bad debt, but I definitely expect there to be a lot of restructuring or bankruptcies, personal bankruptcies in America. It's very easy in this country. Our society is set up for whatever reason to make it very easy to take risks and then get out of that through a bankruptcy. We also know, like we said, the Fed is committed to low interest rates. There's something called the wealth effect, basically that as interest rates drop, your housing prices will jump. We'll look at that here in a second. I'll prove that to you as well. That's occurring. But if your house goes up in $30,000 to $50,000 in value, say, you feel richer, right? I mean, you feel like you have more wealth, and maybe you can take out some equity on that house and, take a vacation, put in some new windows, put in a new driveway, who knows, whatever, get a car, I don't know, do whatever you want. So the low interest rates are also going to be helpful in encouraging investment by businesses in order to start this ramp up or whatever in order to climb out of the recession. So it says that there's basically a rally in the mortgage bonds guaranteed by government agencies. Ginnie Mae, Fannie Mae, Freddie Mac, says investors. I want to point this out because this is one of the key points of my argument that I'm trying to make here. This article makes us believe that these are all government agencies, right? That's how it reads. Truth be told, Fannie Mae and Freddie Mac are going to be seen as basically independent corporations that are not tied. Their loans aren't guaranteed by the government, is what I'm trying to say. That's very important. There is some of that, and we'll look at that for Ginnie Mae, but for these other two, no. So this is one really interesting thing and very important. We said the Fed bought more than $600 billion of agency RMBS. This is residential mortgage-backed securities. The spread was higher back in March, so this is when I guess a lot of people said the buying was good. Now the spread is much smaller. But the Fed isn't the only one buying. Demand for, again, look at this. What do they call it? A safe haven asset has jumped when the pandemic first roiled financial markets and has persisted ever since. Are they saying, are they insinuating? Are they purposely being unclear that mortgage-backed securities are somehow grouped in with so-called safe haven assets? Like treasuries? I mean, investors have rushed into agency, RMBS. Agency, that's an important word. It means basically backed by one of the three previous organizations we talked about. Ginnie Mae, Fannie Mae, Freddie Mac. Those are the agencies, right? And again, look at how they say it, which have the benefit of government backing. I'm going to show you an article that says that that's a false statement. So this is from Reuters. I guess Reuters and Investopedia can argue about it, but I think that's one important thing that I'm going to go better safe than sorry. I'm going to go with Investopedia, and I'll show you that here in a second, while also offering a higher yield than Treasury debt. Yeah, of course, no one wants to hold Treasuries right now. So yields on the Treasury bonds have fallen to all-time lows since the Fed cut interest rates near zero. They're planning on staying there. We have agency MBS, our Treasuries on steroids. This is a quote from Greg Parsons. He's the CEO at Semper Capital Management. They try to argue that there's this big prepayment risk, but I think most of the risk is actually people defaulting. I'll show you some of the stuff about the end of the unemployment benefits for 2/3 of people who are receiving those, and also the end of the moratorium coming up for these eviction protection policies. The article continues, but banks are likely to keep buying. Though they may be overtaken by the Fed this year, commercial banks are currently the largest holders of agency MBSs. Flooded with deposits during the crisis, big banks have put that money to work in agency MBS, among other securities, bringing their holding to $2.3 trillion. $2.3 trillion. You're going to love this graph. Just hold on for it. It says, if you talk to a Wall Street firm, they're making huge money selling to banks right now, says Kenneth. He's a portfolio manager at DoubleLine, which manages strategies that invest in both agency and non-agency MBS. So that's interesting. Non-agency, there's no one there to save your lunch. No one's going to come to help you on the non-agency stuff. So there, at least we have an admission that Double Line is one of the firms involved in getting into these full risk exposure type things. Now, they might hedge it some way, maybe with some insurance or something else, but he basically says there's an insatiable demand for agency mortgages by all the depository institutions. The deposits are up, saving rates are up, everyone is kind of hoarding cash. So people are bringing in these truckloads of cash to these banks, saying, hold on to our cash for us, and the banks are basically, meeting their reserve requirements and investing apparently a large portion of it. He says insatiable demand. I mean, that sounds quite like a lot of mortgage-backed securities are being purchased. This is from the Fred. It's out of St. Louis, Federal. They run economic research. We're looking at Treasury and agency securities, mortgage-backed securities, all commercial banks, the amount that they're held. We're here at $2,500 billion. So that's equivalent to 2.5 trillion. Well, just to give you a perspective, the American economy maybe has 24, 25 trillion GDP. That's a ballpark number. I could be off like a couple up or down. Pretty interesting. Obviously, the most shocking thing is that you'd think, well, after 2009, we got off these things, right? Not at all. Look, every year it's been increasing steadily. Here's the other one, assets, securities held outright, mortgage-backed securities. Wednesday level, I'm not sure what Wednesday level is exactly, but here starting in 2008, there was a dip down, but 2020, apparently it's been a hot ticket, like we were just reading about. So that confirms what those articles were saying about the demand. Obviously, a lot of people holding those. Now, this is where I'm saying, and I guess a large crux of my argument does depend upon this, Investopedia accuracy. Let's see who we can pin this on. Matt Lee, it's updated September 25th, 2019. Matt basically breaks down for us the three main agencies that they refer to when they talk about agency MBSs. So the first one, Fannie Mae, I mentioned that this is not backed by the government. Note that Fannie Mae's guarantee is based on its own corporate health and is not backed by the government. Now, I showed you in the beginning that that was between Fannie Mae and Freddie Mac, that was about 60% in like 2015, 16, 17. That was about 60% of all these things outstanding. About a third of them were under Ginnie Mae, which is covered by the government, but I'll get there. Let's jump over to Freddie Mac really quick before I move on. It says, like Fannie Mae, Freddie Mac can issue and guarantee MBSs, but its guarantee is not backed by the government. So there's your two, where people in these articles are saying, agency MBSs, these are great. These are backed by the government, no problem. There's very little risk. They're basically as risky as treasuries. Well, if this article is right, then that's not true at all. That's not true at all. And you should be thinking when all these people lose their unemployment claims, when they get kicked out on the street, clearly no one's going to be paying those mortgages in January, February, March, whenever people get evicted, right? Now, Ginnie Mae, the Government National Mortgage Association, differs from Fannie Mae and Freddie Mac in that it operates as a government agency. It does not issue MBSs, and its guarantees are backed by the full faith and credit of the U.S. government. Furthermore, Ginnie Mae guarantees MBS issues from qualified private institutions. Ginnie Mae also has more stringent guarantee policy in that it mainly guarantees loans that are issued by the FHA, so the federal. Finally, there's some private insurers. They can also do MBS, as we saw on that graph from Wikipedia. Those pretty much disappeared by like 2014. If, on the other hand, it's not qualified by Ginnie Mae, then the MBS issue is not guaranteed. So that's what we saw Double Line was trading in. They were trading in those non-secured. All right, so speaking of the FHA, this is the Federal Housing Administration mortgages. FHA mortgages delinquencies reached a record led by New Jersey. This came out in the summer of 2020. The share of late FHA loans rose to almost 16% in the second quarter, up from about 9.7% in the previous 3 months, and the highest level in record dating back to 1979. The Mortgage Bankers Association, we often see that in MBA, said Monday the delinquency rates for conventional loans by comparison was 6.7. So that's still a lot. This is from Bloomberg, and this is going to have a kind of a yeah, but. This is going to say, no, hold on. Banks are going to actually do outstanding. And so I thought that I needed to, for sure, put this in to this report. So banks uncover a loophole to buy home loans at below market prices. August 20th of 2020. This is, banks and other lenders have found a way to potentially make billions of dollars from the upheaval in the U.S. mortgage market, yet it risks burning bond investors in the process. The earnings would come from an anticipated side effect of Congress's decision in March to allow homeowners affected by the pandemic to delay loan payments for as long as a year, combined with arcane regulations governing mortgage-backed securities. So what they're basically going to do is they're going to wait until they can find somebody who's 90 days late, which under Congress they were allowed to do that, right? Apparently, these banks are going to be able to go into these package securities, pick out the ones that are 90 days late, and basically buy them at a discount. So Wells Fargo, U.S. Bank, already buying, and frustrating bondholders who say purchases are leading to losses. Lenders counter that the practice is hardly risk-free and has more to do with accounting issues than trying to score a quick profit. Now, I mean, obviously the homeowners don't believe that for a second. Here's what Ted Tozer says. He's the Ginnie Mae former president. He says the banks are setting themselves up for a huge windfall, like massive, massive profits. He says it's almost pure profits. The key to the transactions is Ginnie, a government-owned corporation that guarantees the payments of principal and interest on bonds containing mortgages insured by the Federal Housing Administration. So the way it works is Ginnie rules allow banks and other lenders to buy loans out of mortgage securities, so like these bundled securities, right, at their par value when the borrower hasn't made payments for 90 days. Well, how many people just got provisions from the government to miss 90 days of payments? Well, apparently they can and not get evicted, but also it appears that under these Ginnie rules, these banks can swoop in and basically buy it out from under these people. Investors value most of those loans at 5 to 10% above par, meaning the purchase results in an immediate write-down for the bondholders and a potential profit for the lender when they're able to resell the loans. So it's not like people are going to lose their homes in this situation. It just means that, if we had that package deal that we're all invested in, that package of securities, maybe Wells Fargo comes and picks out a couple of our winners, right? Things that we would expect would be good. I don't know. But basically they can kind of come in and get those out from under the package security that it was in previously, which means that this is bad for us. What we see is that basically Wells Fargo bought up about $19 billion of loans, these type of loans, and the U.S. Bank Corp bought about $5 billion of such loans. So Wells Fargo spokesman Tom Goda said that the bank, Wells Fargo that is, regularly buys delinquent loans out of Ginnie pools to manage balance sheet impacts and reduce expenses. He says that they do that regularly. So we're told that loan buyouts aren't new, but what's different is the current situation is the sheer number of homeowners who've opted to delay their monthly payments because lawmakers have protected them from foreclosures. So maybe they don't know about this other thing that could happen to them. Many, if not most, of those borrowers are expected to start paying their mortgages again. That means that, unlikely in the 2008 financial crisis, lenders that buy delinquent loans may be able to easily resell them at premium prices as mortgages become current. So then Ginnie said, okay, here's what we're going to do. We're going to have this new rule. It means essentially that the servicers are forced to hold the loans on the balance sheet for at least 7 months before being allowed to repool them into new securities. So that means they can get stuck holding the bag. You know what I mean? They're required to hold these things for 7 months. They're obviously not going to be making any money on that. Well, the banks argue that this is not riskless, and that's what we see right here. Still, the Bank of America mortgage security strategist Michael Conkin said lenders that engage in extensive buyouts do face potential downside. It's not a riskless transaction, he says. Who notes borrowers might default while the lender holds the loan, or government agencies could change the rules for when the mortgages can be re-securitized, so repackaged and then resold is what he's meaning. And I would argue a lot of the people are going to default. I mean, it depends. 7 months is a long time, but 2021 could be pretty ugly. While banks have done most loan purchases so far, the profit opportunities could incentivize non-bank lenders to join in. So that'd be even more people piling in. This is folks like Ocwen, like Mr. Cooper's, like PennyMac that we see down here. If non-banks were to conduct large-scale buyouts too, then Ginnie securities will trade even worse. For consumers to obtain a Ginnie-backed loan, many whom are first-time borrowers or buyers with low incomes, that would lead to higher mortgage rates. So people maybe are out of work and maybe their rate goes up. You're going to tell me that that's not going to lead to more delinquencies, more foreclosures. Certain factors could suppress non-bank purchases, but then they go on and they find out from PennyMac, their CEO, they asked them, they basically said that on their earnings call this month, the firm might tap some of its liquidity sources to buy more Ginnie loans out of these pools, describing the purchases as a quote-unquote opportunity. Their CEO, David Spector, said in a statement that there are high costs involved in managing government-guaranteed loans and responding to borrower hardships. The potential revenue opportunities as presented by Ginnie Mae's early buyout guidelines are an important offset to appropriately reimburse these expenses for a large Ginnie Mae servicer like PennyMac. So what he's basically saying is like, well, we're going to make a lot of money, but it's going to cost us a lot to do it. I guess that's his argument. We all know that before the financial crisis, home prices were very elevated in 2008, here in this period, 2006, 2007, 2008. This is 2006 right here. Blue line is the U.S. aggregate. You can see here, we're up at the 145 level, and this peaked at about the 152, 153, getting pretty close. That's the Case-Shiller Home Price Index. Yeah, the banks, they've gone too far. If it's as these people are saying, and you might want to look up, like they said, Wells Fargo is forced to list any in-the-money mortgages that they're holding as options. So, maybe we could go and look that up. So the first product that we're going to look at, SCF, if I've been successful in arguing that there's going to be a short-term downside, if all those people lose their jobs, 2/3 of people, if the moratorium on evictions comes to an end on their loans, and who knows what might happen. They might not move out. They might just stay there and not pay, wait for the sheriffs to come up. Who knows. But this first product, SEF, is from ProShares, Short Financials. It provides inverse exposure to market cap-weighted index of U.S. financial services companies. Those companies are the following, according to their fact sheet. They have 8.82 Berkshire Hathaway Class B, 7% on Visa, 6 MasterCard, then JP Morgan, Bank of America, American Tower Corp, Wells Fargo, Citigroup, S&P Global, BlackRock. So 30% diversified financials, 21% in banks, 20%, 21% in real estate, and then some in software and insurance. So that's just the single. It's not leveraged. It's just the inverse. So the second product is going to be ticker SKF. It's also from ProShares, and they call it their ultra short financials. It's exactly the same weights as the ones we just looked at. The only difference is this one is leveraged negative 200%. So the last product, the one recommended by Rick Rule that he recommends to his investors, who are primarily precious metal investors, is the FAZ. It's a triple bear, they call it. 3x shares, 6 daily investment results before fees and expenses of 300% or 300% inverse for the performance of the Russell 1000 Financial Services Index. And make sure that we know that there's no guarantee that they're going to, be able to perform. So if we look at it by sector, they're 33% shorting the banks, 27% capital markets, 21% insurance, diversified financial services, consumer finance. Everything down here is very, very small numbers. So it's basically all in the chunk of this top 4, primarily banks. So this is almost 14% shorting Berkshire, JP Morgan, Bank of America, Citigroup, Wells Fargo, S&P Global, BlackRock, Goldman Sachs Group. You should watch some videos about the way that these inverse products work, especially if you were looking at it over time. So the example that I gave would be like a one-day example. I think, honestly, if it went down 1%, that the asset, the FAZ, if it was 100% linked to just like, say, JP Morgan, it would go up 3%. But that would not occur if you do 2 days, 3 days, 4 days, stack multiple days in a row. It is an ETF. I guess you could also get into puts if you'd like, if you have that option with your brokerage. You could also go after some of these, maybe these big ones. We looked at JP Morgan, Citi, Wells Fargo, obviously. And Kramer loves to beat on that guy, Wells Fargo. I think he really likes the CEO, but I think he thinks that the company is just awful. That's the long and the short of it. I hope you guys enjoyed the video. Let me know what you are going to do. A lot of people say that it's inflation. It's just going to drive asset prices higher and higher and higher. True. I guess what I'm asking is, have these companies gone too far with these mortgage-backed securities that are really derivative products that got everybody into a lot of trouble about 12 years ago? Are we back on the same position? Are we getting ready to ride the same roller coaster? Well, I don't know, but this was really shocking to me. So I'll leave you guys with that, and we will talk to you next time.